And just before I start with a few questions, so how it'll work is there's been a number of questions sent in, and look, thank you all for sending the questions in. So I'll start off with a few, and then we'll open it up broadly to questions, and we'll just go across, the areas and come back. But before we start, in terms of I'm the portfolio manager for WAM Strategic. We haven't. I haven't presented on that. I'd just like to give you an update. We're disappointed that the share price is trading at a discount to NTA. It's at a little over a 10% discount to NTA. We're happy that the portfolio that we've got there has been delivered us a good income. And if you look through, we announce on a monthly basis the look-through NTA, that's above $1.40 in terms of the various funds we've invested in. Obviously, our plan will be, it's delivered what we expected it to deliver, probably a little bit under in terms of performance. And just on that, I think a lot of people thought, what we're doing is we're buying assets at a discount. So sometimes it takes a long time to build a position in a company. Well, one that WAM Global ended up taking over is Templeton Global. I think it took us 10 years to build that position. So some people are expecting catalysts every week in terms of takeovers. That's not the case. We're buying discounted assets and we're buying them when we believe there's a catalyst for eventually the assets to trade at NTA. So to me, everything's on track there. The plan is to continue to grow the dividend. If we have a good year, then there will be special dividends, which we paid just recently, but that's on track. So why don't I now sort of open up to some of the broader questions. And I'm just trying to think, they've changed the questions. Changed the questions from yesterday, keeping me on my toes. So let's start with Oscar. I haven't read this question yet. What is the question?
What it's gonna be,
Yeah, you spoke about takeovers in your presentation. What are some examples of takeovers that you've seen across the portfolio this year? I'd prefer to know, this is what has been written, what takeovers are going to occur later this year that haven't occurred?
Well,
maybe that's a...
I can tell you...
And will there be more... do you think there'll be more takeovers
I definitely think
in the
so.
space? I mean, and why?
Yeah, so I remember being up here 3 years ago, and I think we had 3 takeovers in the space of like 3 weeks. And I know I said we've had 6 in my microcap this year in my presentation, but I actually think it's since that 22 sell-off, I reckon it'll be close to 20. We had one last week, the Reject Shop, and it hadn't been a good investment for us. And Dollarama, who's a Canadian discount department store, came in and offered 112% premium to the Reject Shop. That's insane. I've never seen that before. It's great, don't get me wrong, it's fantastic. But that should give you an indication as to how cheap some of that lower end, the lower market cap companies are. And if you look at our portfolio and we're microcap, now the hard thing with microcap investing is if you get something really right, it does really well, like a tour that I talked about today or a generation development group. But if you get something wrong, it can, due to liquidity, lack thereof, and lack of interest and uncertainty in the market, it just loses interest. And that's what happened to the Reject Shop for about 3 years. Had a good period and then underperformed, no one cared about it. Now, we would have quite a few stocks in our microcap portfolio like that. So my answer, Geoff, is yes, I think there will be more takeovers because I think that part of the market is incredibly cheap. I think it's attractive for private equity and for offshore buyers. And you look at Dollarama, Australian dollar, what's the Australian dollar? I should know, but what, 64, 65 cents. It's pretty attractive. It's very attractive for an offshore buyer, so I think it'll continue.
Are there any particulars you think are vulnerable? We can all
putting me on the spot. No, there's two. Well, we've got one at the moment, Smart Pay, which is in the payment sector. Again, hasn't been a good investment for us. That's under potential takeover from a mystery offshore bidder. We don't know who that is entirely, but I could see a bidding war emerging there. I think there's a lot of cheap retailers at the moment and automotive companies. So, like, give an example, Auto Sports, which we own, and the car dealing side. You're getting the operating business for free, you're just paying for the property right now. That's a good example of something. It's on a price earnings multiple of like 5 times at the bottom of the cycle. We've got another payments company called EML, which I think, again, you're paying for basically their cash that they've got that's earning interest at the moment, but you're getting the operating business for free. I think that potentially could be taken over. But yeah, I mean, this year we've had DropSuite, PointsBet, Capital Health, the Reject Shop. There was 2 others, I can't remember. But it's a lot. It's a lot.
And just I know we've gone for quite a period of time, and you'd be disappointed I haven't mentioned franking, but I can't help it now. Because unfortunately, before the last election, back in 19, obviously, for those that were here, we're all holding our placards. And they, before the last election, the current government said franking's off the table. In 2003, during this period, unfortunately, they broke that promise, and they changed the ability for companies to pay out, do buybacks to make them fully franked. But in that legislation, they put a couple of lines in there. Is this being recorded to everyone? Is this public at the moment?
Yeah.
Okay. I just wanted to, I was going to call someone really smart or really dumb, but I won't call them that. So the person is either really smart or really dumb who put those lines in there. And what it does, it actually makes it's a disadvantage to be listed on the ASX now. So if you're an unlisted company, you're better off being unlisted. Because if you're unlisted and you do a buyback, any type of buyback, then you don't lose any franking on a per share basis. If you are listed, every listed company that does a buyback, and I'd say 99% of corporate Australia don't understand this, if they do a buyback, then they lose franking on a per share basis, depending on how much retained earnings you've got. So if you're an unlisted company in Australia, you'd be mad to list on the ASX. To me, that is appalling legislation. And in terms of on advocacy, obviously, we thought it was shocking behaviour. APRA, sort of banning hybrids. Now, so 44 billion of hybrids is going to slowly disappear over the next 7 years. We tried to fight hard for that not happening, and also we think it's really poor, just bad policy that in terms of superannuation, that because industry funds can't account for how much realised profit you have on an individual basis, that the government changed the legislation to tax unrealised gains. So for us, we just think that's really bad form. And what the risk is, it's the thin edge of the wedge. And what it'll make, they're worried about. We've done some numbers. There's $1 trillion. So look after the industry funds and the union funds. You haven't got the accounting software to do it. So we'll leave you and we'll disadvantage $1 trillion that's in the self-managed super area. We'll encourage you not to take risk. We'll encourage you to just put your money in the bank. And we've calculated that about 155 billion of that money will end up flowing into housing. Because if you're not taking risk and you're going to get taxed on unrealised gains, then what investment in Australia is no tax? And that's your own home. So yeah, we think that's unfortunately the unintended consequences of their current policies are, to me, very disturbing. So that's anyway. I'll calm down now.
That came from takeovers.
I've got that. Sorry, I've got that off. No, because so many they're all going.
Yeah,
so
that's
like,
right.
ASIC's talking about, doing an inquiry into private debt, but ASIC in their in terms of what they're looking at, they're going to look at how can we have more companies listed on the ASX. Well, you won't. The only way you do it is change the legislation. Change that one paragraph that either the smart or the dumb person let get through. Anyway, sorry.
How would it all work with the banks with hybrids going? So the franking, which they pay out through hybrids, and all the banks are doing buybacks, and in an economic cycle they raise capital too.
Yeah.
They'll be effectively locked out, the franking on.
Well, because in theory you can't, any dollar you raise, if it's associated with a dividend, it's not franked. So to me there'll be continued franking build-ups. Yeah. So it won't go. Yeah. To me, the whole risk about this. Oh, and in terms of, please, if anyone wants to write to their member, and someone was talking to me outside. They said, "Oh, it's good. Franking's off the agenda. We're trying to get it back on the agenda." Last election, they said that they wouldn't change franking, and unfortunately, they broke their promise. We need to get, please write to your member if they're in government, and ask them confirm that they will not touch franking if they win this next election, because the odds at the moment are saying they'll win, and because no one's talking about it. So if they win, then they'll say they've got a mandate to change franking. So anyone who's interested in keeping the franking system, and everyone says, "Oh look, so why are we so passionate about franking?" And just on that, what would it do to our business? Actually, if they got rid of franking, our business would be exactly the same, because we'd change all our structures from companies to trusts, and instead of, say if we were making 10%, and we're paying 30% tax, which is 3%, and we pay you a dividend of 7%, and because it's 7% franked, so you get the 3% back, that's how it works. We'd change all our structures to trusts, and we just pay you 10%. So it actually has no impact on our business whatsoever. Why are we standing up? Because you guys, because we know the significant impact, and actually it would have an enormous impact if they dismantled franking on the Australian economy. Australian jobs, Australian business, Australian companies paying tax, employing Australians. But anyway, they'll have to work that out themselves, the politicians. So back on track. Sorry about that. Got all that off my chest. I'll sleep well tonight. So, Catriona, in terms of takeovers, have you seen?
Globally.
Yeah, globally, many happening there.
Yes. Well,
and have you benefited from?
Yeah, we have.
And are there any tips for us?
Well, we got one overnight actually. We've got a stock Alpha Wave, which we own in the global portfolio, which is up 46% overnight. On a takeover, Arm was looking at it, which is the chips.
This is like my dad. My dad used to always say, "Tell me the day before, not the day after."
Well, we've got you just owned WAM Global. Yeah. And now Qualcomm is a potential bidder for the same company. So we do think, in recent years, the market that has been in some ways decimated in relation to what you're talking about, Geoff, but the UK market has been a real mess, and the valuations are incredibly cheap there, and we've owned some great stocks that have all been that have been subject to takeovers. So we had Entertainment One, we had Biffa. So a waste management company. Entertainment One was, I don't know if anyone was here for the first WAM Global roadshow, but we talked about they were the owner of Peppa Pig. Yeah. That got taken out. Biffa is a waste management company. It got taken out. So the UK market has been incredibly cheap post-Brexit and has been basically a hunting ground for everyone else globally. So the US companies have gone to the UK with the pound being being hit so much. and taken advantage of that. So we had a number of companies there that have benefited from takeovers. But the market that's interesting now is the US, because with potential deregulation under Trump, we will potentially see more M&A, and with rates coming down, there's a lot, like the small mid-cap end of the market, like Oscar talked about it. I mean, it's been a real underperformer in recent years, just with uncertainty, and it's where there's huge valuation disconnect. So, you know, you've got 20-year lows for small mid-cap companies when you look across the US and globally. And so that's a real hunting ground for takeovers and M&A. And so, yeah, we've had one overnight. We think there'll be more.
Excellent. And just on, probably not especially takeovers, Nick, because, you know, but in terms of, you know, what sort of sector, you know, do you think in the alts, you know, gives you the, you know, greatest, are you most comfortable about and think's got the greatest upside?
Yeah, thanks, Geoff. I mean, so just to recap, so we're investing across sort of private equity, real estate, infrastructure, private debt, and agri and water. Now, all of those sort of sub-asset classes have a role to play in this portfolio long term, but the weights will flex over time based on where we see opportunities and where there's value. We have a small holding in private debt at the moment, just under 5%, so we're looking to increase that closer to 10%. That said, we are treading very carefully. There's definitely some cracks appearing in that part of the market. Most of those cracks, though, are focused on the real estate debt space, and in particular lending to residential developers. To be clear, we have no exposure to that space, and we are not looking at that space. It could become interesting in time if there's enough distress in that market. Maybe there's opportunities. But we're looking at doing more in the corporate senior secured space, which is where we currently have exposure. Infrastructure has been a really good performer in our portfolio. It's a very resilient asset class, particularly in a high inflationary environment that we've been in, because you can obviously pass through the inflation. And then as the guys talked about, where we are in the rate cycle, if we start to see rates come in the back end of the year and into next year, we should see real estate start to perform quite well. There's a sort of very high correlation between rates and sort of capitalisation rates on real estate. So the capitalisation rates effectively income over price. So they will come in, which means the price of commercial property should rise as rates come in. So opportunities to be sort of nimble given that backdrop.
Great. Now, Matt, just on you. So tariffs. So we'll find out tomorrow morning, will we?
Yes, we will.
What time is it? 4 o'clock he's making the announcement? What's he calling it? It's,
Liberation Day.
Liberation Day.
Yeah.
So with Liberation Day tomorrow, so what does that mean? Does it worry us more? Does it worry us less?
No.
What do we do?
Everyone's worried now, so like
That'll have occurred.
there's
What time does it happen?
I don't know on the Eastern Standard Time, but the perverse thing is.
Well, now because Damien works with you, you don't have to ring him at 2 in the morning.
No, we still chat. It's fine. But the perverse thing is, often you get a rally after an event because everyone hedges into an event. So what we see repeatedly is when the actual event comes out, all the hedging falls away, and then volatility falls. And that when volatility falls, you get all these leveraged buying. So you normally want to be long on the event day because you get the resolution of the event.
Yeah.
So it's normally lasts one day though, to be honest. Like, don't get excited if it rallies, it can fade quite quickly. But what do we expect? I mean, we'd all have our own views, but I don't think it's the end. Like, he's already talked about pharmaceuticals now, and so we won't get a resolution is my bet, but we'll get the one-day potential rally.
So he'll come out and say, you know, tariffs are going to
Blanket across everyone.
Everyone.
And then it's reciprocal.
No one's spared.
No one's spared. Australia will get...
Come and grovel to me and I might change
Correct,
it.
yeah. So, it's just, unfortunately, it won't be a resolution, but for the short term, we will get that resolution. But for us, what does it mean?
Yeah, with the portfolio.
Yeah, like we're sort of positioned defensively now anyway into it. Still think momentum is not the way to play it. Like, I think we've all agreed that there's different areas of the market now which will rally from here. So we've already positioned.
That was the old game. Yeah, that people were
2024 momentum was the game. Passive. This year it's all about active management. So volatility is where active kicks back in. And
Trine, what about you were saying how you position the portfolio? Any little insights you can give us?
Well, so in terms of the tariffs and last year was the year to really position. Like, we had a view that Trump was going to get into power. We deliberately positioned away from anything we thought that would be tariff affected then. Increased our weightings in things like the exchanges that I talked about earlier, where they're big beneficiaries of volatility. So yeah, for us, it's not about positioning now. Now is about hunting amongst the things they're getting really sold off for opportunities.
Well, like the humanisation.
Humanification.
Oh, humanification, sorry. I hate those new words like they create. Yeah, okay.
Exactly.
And Oscar, anything particular, how does it impact tomorrow? How will tomorrow be different to today for you in terms of investing?
It's a hard one in small caps. Every company has its own story. So I remember when the noise around tariffs started, and you look at your portfolio, and I think we had one company that was directly impacted. But the problem with small caps, highly volatile.
Yep.
So they get hurt in periods like this.
Okay. What else? Any other questions I should specifically ask? Any other questions you'd like to answer before we open up to everyone?
Probably from our point of view, we never get takeovers. I don't think we've had a takeover in 5 years.
Yeah.
All our companies buy stuff and perform really badly when they buy stuff. So we're on the opposite end.
Okay.
Any acquisition that's been done has been looked upon very unfavourably over the last period. So it's a real difference between the portfolio sets. The big companies are buying the smaller ones and overpaying, and we get hurt effectively when they do that.
Okay, just one thing I might cover off on, which I had a couple of questions outside. One is the premium and discounts to NTA of LICs. Now, there are some large LICs that are trading at quite big discounts at the moment. The thing is, for an LIC, sort of what drives an LIC to trade at NTA or premium or a discount? It is as simple as supply and demand. Now, it's very simple to say that, because where is equilibrium? It's NTA. But what you have to do is effectively all the shareholders have to be happy with the investment and not be prepared to sell at a discount. And other shareholders have to be prepared to pay NTA. Now, that's why we have, we employ, 13 or 14 people in our shareholder engagement, communication and engagement area, because we think that's very important to try to get that equilibrium. Sometimes it takes us quite a bit of time to get the companies to trade at NTA. WAM Research, it took us 7 years. In the early days, some of you may have been shareholders when WAM Research traded a big discount NTA. Unfortunately, we did too good a job in tightening the register. And I think, was it 2.5 years ago, it was trading at a 52%?
Close to 60%.
Yeah, I think it was 58%
yeah.
premium, which is as ridiculous as something trading at a discount. Now, Nick mentioned WMA is trading, I think he used 19.1 up there. I think the live one's 18.4. So maybe someone listened in Canberra. The discount, that's the biggest discount. And the biggest premium is WAM Research. I think it's about yesterday on the live NTA, we thought it was about a 12% premium. WAM Capital's, I think, about a 5% premium. And the discount, there's 5 of ours at NTA or premium, and 3 of them are at discounts. So we like to buy things cheaply. I don't know if it's my Scottish ancestry, but so if you're looking at LICs, try to buy them at a NTA or a discount. In terms of, there were some questions outside about WAM Capital. Hey, look, I bought at $2 when it's going to be back at $2. What you've got to remember is when COVID started, most companies cut their dividends. We didn't. We kept it the same. So we've been paying you a really high dividend over that period of time, close to 10%. So to do that, I know it's 60% franked, So to do that, we really have to deliver 13 or 14% at the pre-tax level. Now, Oscar and the guys, I can't remember, like, was it 4 years ago we're thinking we're going to have to cut the dividend? And then a year ago we thought we were going to have to cut the dividend again, but only because the exceptional performance by the team, we've been able to keep that dividend going. And I said, look, if we'd cut the dividend back in at the start of COVID to half, so still a good 5% yield, then in theory you would have had another 40 cents of capital that we wouldn't have paid you. So we would have been back at $2. So and back then we were trading at a 25% premium odd 10 TA, and now that's come down. So I just wanted to put there are a few questions I've had out there. Any other things we want to cover off on, that general questions before we open up to specific questions, or messages? No. I think that's it.
No, I think so.
Okay, let's start with the questions, and we'll start far right and we'll move across. So, Emiko, anyone in this area? Oh, there we go. I'm going to start here while we're just waiting for Emiko. Thank you. Good to see you. Why don't we start?
You're going to start with me?
Yeah. Well, you're a long-term shareholder. How long have you been coming to these?
I'm not quite sure. It's somewhere around about 2004, 5, something like that.
Thank you. Thanks for your support.
And
hey, thanks for coming back.
I'll still be here so long as I can breathe. My question is relating to takeovers, maybe different to some of the things that you've been talking about. We've got super funds in Australia worth about $4 trillion. And the commentaries I read indicates that they're about 70% invested overseas. If they invested a bit here, it would cut the debt a little bit, but that's only one part of it. Why are things like, I'm just looking at Healthscope today, Jennings, smaller companies, Clean Seas, Tassel, why are they so attractive to overseas companies but not regarded as being investable in by Australian super companies?
Okay, good question, and two parts to it. I'll answer the first part, and Oscar, do you want to answer the second part?
Yeah, sure.
Yeah.
And I'll give some perspective on why global companies hunt here.
Beautiful, and you'll do the third part. Okay, so the first part is you're saying, the $4.2 trillion that's in superannuation in Australia, why isn't more of that money invested in Australia than invested overseas? And we agree with you. And let me give you an example. I think Catriona mentioned about the sort of the dire straits of the London capital markets. And sorry to do this, but I'm back to franking. In the UK, they had a system similar to franking, and it was called the Advanced Corporation Tax, ACT, and they brought that in 1973, and they had it in for 26 years. And over that period of time, it was slowly dismantled. They took a bit off here and a bit off there, and to me that's the risk of what's happening. Matt's talking about the billions of dollars that's now going to be trapped in the banks because they've stopped hybrids, they've stopped the buybacks. I would say they'll wait for one person to die that created the franking system, and then that's the end of franking, depending on who's in government. So they had it for 26 years, and in 1999, the pension and the union and the industry funds in the UK, they owned 40% of the listed stocks in the UK. Since they got rid of it, because there was an incentive for them to buy UK companies, because stopping the double taxation. Since they got rid of it in the UK, now it's 5%. The pension funds, all the money went overseas. So if you get rid of franking in Australia, that $4 trillion will be invested overseas. What's that? I know 70% of it is, 99% of it will be. Yeah, CommBank, we're probably trading at $40, or if that. What's the NTA of CommBank?
Valuation, CommBank's worth about $70 on a DCF.
Yeah. But I'm probably trading at a discount to that.
Probably,
yeah. So to me, that's the risk if they get rid of franking here. So that was sort of, I wanted to get that off my chest again. Now, Oscar, do you want to talk about the other part?
One thing Matt talked about in his presentation today was around momentum. And, certainly we talked about the rise of passive money. And what that means is that when we see a lot of companies, it's all about getting bigger. Companies want to get bigger because it means they're more important. They go in the ASX 300, they go in the ASX 200 or 100, and the passive money has to buy them. And so what happens, like you gave AV Jennings, I think it was, as an example. I mean, AV Jennings is a very, very small company. It's not in an index. And so for fund managers and for investors alike, what's the catalyst for that company to get bigger? And in the end, there probably wasn't a catalyst, and that was why it traded at such a big discount to its net tangible assets for many, many years. I think the market cap might have been about 100, 150 mil, something like that. But then I think it got a takeover bid for over 100, close to 100%, I think, a few months ago. So that's, like I talked about in my presentation, the smaller end of the market, it is a big issue at the moment. And something needs to change because there's just a lot of companies like that, very undervalued, but there's no catalyst for the passive money to buy those companies because they're not in an index. So that's why we think like a lot of this acquisition takeover activity will continue.
And unfortunately, that legislation,
yes.
The super legislation means everyone just wants to match the index.
Yeah,
absolutely.
What's that called?
Your future, your super. Yeah, your future, your super.
Yeah.
I mean, the other
who brought that in? The current government?
Current government,
Or the previous government?
Yep. So you're in the bottom you just get ACTs, basically.
Can I just add one thing as well? So I've come from the world of consulting to superannuation funds and pension funds. One of the other big challenges we've had is the pace of consolidation in super. Right, we've gone from a market that had 500 plus different superannuation funds, and we're heading to a market that'll probably have a dozen in 10 years. It's going to look a lot like the Canadian superannuation system and others. And so the challenge is as these superannuation funds get really, really big, it's very hard for them to operate in the space that Oscar plays because they're just so big. And perversely, though, that creates opportunities, right? Because the money does go offshore and then things become undervalued. And we see it in private markets as well. We've got a real estate strategy that we've invested in within WMA. Some of the big supers wanted to do it, but they were just too big. They need to write a $500 million check. And we're sitting there going, no, these are 20, 50, $70 million properties. It doesn't work for them. They've just gotten so big because of the pace of consolidation. Unfortunately, it's not slowing down, and the current regulation's forcing more of it.
And that's why, we've got to try to keep supporting the self-managed super funds.
Yep.
And unfortunately, the current government is doing, and they tried to do it back in 2019, try to disadvantage self-managed super funds.
And from the global perspective, I mean, if you've got a global company and they're facing a less clear economic outlook and their growth is slowing, very often they will go hunting around the world for opportunities to bolt on M&A to make their earnings look, like they're continuing to grow, etc. And so hunting in a place like Australia is front of mind because rule of law, like stable, operating environment, management that they can trust. There's a lot of reasons to love Australian companies, and so those small mid-cap companies very much fit, in that realm of, opportunity for those offshore companies that want to go hunting for assets. And the same with PE. Like you've got private equity where, trillions of dollars sitting on the sidelines needing to invest, and Australia is a great place to go hunting. It's why the UK has been a great place because there is rule of law, so it does make it a hunting ground.
Okay, now we had a question over there, yes?
This is one's for Matt. Could I have your view on Star Entertainment?
Sure.
Hey, good question. Good question.
Thankfully, one of the worst investment decisions we've had. In the leaders' portfolios, it's actually 0.02 of 1%, so 2 basis points. So Bally, the reason why we stuck around for a while was what's happening now. Like, it was going to get taken over, but again, like, this was probably the thing to note is this wasn't a Star-led business decision. The government actually changed the rules on them, which forced them into this position through legislation. So it wasn't, they obviously did money laundering like Crown did as well. So not giving them a clean bill of health, but this was a government that changed the regulation on them to force them basically out of business almost. But yeah, now Bally will be probably taking it over. Yet to see the details, but from a leader's perspective...
You were hoping that the bid came at $1
Well,
a long time ago.
About 80 cents we were hoping for, but yeah, who knows what the equity holders will get now.
Like were the guys, I know, is this public? It's yeah, okay.
Still public.
I was going to say, were the guys crooks before, but I can't say, I can't ask.
No, we can't talk about that, but yeah, there's been a lot of misinformation.
In terms of the management, yeah.
Yeah.
No, we won't.
Yeah, we won't comment.
Okay.
Yeah.
Over coffee.
Yeah. But yeah, from a leader's point of view, the impact, nothing from here. Our job is to get the returns back through the rest of the portfolio, which we're actively doing now. So
A mistake? You accepted a mistake?
Oh yeah, it's a big mistake.
We get everyone to apologise internally when they make a mistake.
But the problem is when you make a mistake in ex ante, you can come up with all these reasons, but like the information we had in front of us was quite compelling, but the lessons, you always go, what is a lesson? You can make up a million reasons, but going back to credibility around management.
Do you think that's a lesson?
Yeah.
Is it trust or backing management?
Backing strong management teams.
Strong management teams.
So we knew there wasn't...
okay, the management team mightn't have been as strong as it could have been.
Correct.
So therefore, that was the error.
Correct. Where we thought the other error, we thought asset backing, but
the old Buffett theory, it doesn't matter what management is.
Correct.
As long as the asset, that's your moat. The asset
backing. But they were bleeding too much cash on the operating business side, so eventually it didn't matter what the asset backing was.
Gotcha.
But why they were bleeding money was because of the government. They changed the rules on the tax on them.
Yes.
Which was quite sneaky actually. Was because when...
Were you aware of that?
Yes, but then they walked the regulation back and gave them a phase-in.
Yes.
But the damage, and then they changed the compulsory gambling rules where you got to...
Yes.
I think it was like $2,000 max spend for a night. They brought that in as well, which just killed their earnings. So
yes. Where does risk of government regulation fit in? Where does management risk of government regulation?
Well, yeah, government regulation is everywhere at the moment.
Yeah.
But I mean, if you don't think management is credible, you can't really invest.
Yeah.
I guess that's a lesson.
Yeah. Okay. Thanks. I know we'll move across. We've got one there, yes, and then we'll move across to over there. Thanks.
Thank you, Geoff. I fully agree what you said about the franking credits. Basically, you and I couldn't do anything much. I'm calling on all Australians who has superannuation fund. Please wake up and take notice. Because whoever has superannuation fund, whether they're young or old, one day you will have above $3 million in your super fund. And if the legislation go through, all of us who have superannuation fund will be taxed on the unrealized gains. Any amount above $3 million. And also it will affect franking credits in the future, negative gearing. And I would really appreciate all Australians to wake up and do their best to protect what we have before it's taken away from us. Thank you.
No, thank you very much. Yeah, and that's another thing is, the non-indexation of the $3 million, like Chris, who passed the microphone to use, 26, before, well before he gets to my age, $3 million would be very little if it's not indexed. So it's taking away from the younger people. It's just poor legislation. But thank you very much. And people can write to your members and just be vocal about it. We had a question here. Yes, thank you. Yes.
This is a question to Catriona.
Sorry, a question about which one?
To Catriona.
Train.
Train, yep.
This is regarding, you put out macro themes, but I didn't see anything on climate change. And how do you view companies like Vestas or like wind energy or ammonia? Because combined with climate change, you got food security, so fertilizer, green ammonia. What is your view on that? And I didn't see any examples of that. Maybe you have. The second question is, I think to Oscar, on the some of the companies that you have on governance. Here I'm talking about companies like WiseTech you have. How, as an investor, how do you influence them? Because obviously WiseTech has been very, very poor governance, and retail shareholders like us have no control on what Richard White can do or will do. It's people like yourselves who can influence that. And the third one is to Nick on alternative assets. How do you do the mark-to-market valuations on assets? So there's three questions.
Thank you for the question. So on climate change, in terms of thinking through the ESG factors, we do consider when we're looking at any of our companies, what are the factors amongst environment, social and governance that might affect the businesses we invest in. We're not invested directly in, say, Vestas, the wind. Like, there's a lot of those companies that have had issues with warranties on their wind products, and so we're not, with the way we prefer to play it, for example, on climate change, we own Quanta Services, which was one of the companies I talked to you about last year, which is a play on many different thematics, but including that they connect all the renewables that are being added into the US onto the grid. They don't care whether they're connecting wind, solar, whether they're hooking up the new data centres that the cloud providers are adding into the transmission grid. So we think, say, that as a business, they're agnostic to what energy is being connected into the grid, but we think that's a great way to play the renewables space. Right now, there's a lot of noise around the IRA, which the Inflation Reduction Act, which was brought in by Biden. So there is a bit of uncertainty for any of the renewables players right now in the US around what will be the funding situation going forward. But yes, so we prefer to play, picks and shovels, be agnostic to the type of energy, but certainly be a beneficiary as a byproduct of whatever happens in the renewables space. But we consider it as a factor, but we're not going to make a play directly in the wind and solar space, directly in a business like Vestas, for example.
And maybe just quickly on the valuation point within WMA, so I'm conscious of time. Basically, we have a process internally that we have to go through twice a year. Being a listed investment company, the accounts are audited. So we have to go through a process of verifying and getting comfortable with the valuations on the underlying assets we hold. But it's worth remembering that we're investing with investment partners that then are going through their own valuation approach. And so it differs a little by asset class, but effectively there's independent valuations on all real estate and infrastructure assets sort of semi-annually, and then the private equity is typically independently valued annually. In the first year of holding in private equity, it's usually held at cost before you see the sort of valuation upticks. In private debt, those loans are held at amortised cost through the P&L. And then in water, interestingly, water's a tradable market, so water's probably the easiest of the asset classes from a valuation standpoint.
And just on that, Nick, of the various assets that have been sold, what discount or premium to NTA have they been sold at?
Yeah, so there have been 12 exits since we've been managing the WMA portfolio, and those exits have averaged out at a 35% premium to NTA.
So we're not saying it's undervalued by 35%, but just that's...
Yeah.
So the valuations, we're happy with the valuation,
Absolutely.
I suppose that's it.
Yeah.
Do we cover...
Governance.
Oh, WiseTech, who's
I think
how do you...
Yeah, for WiseTech, I mean, for us to influence, we have to be a big shareholder, and within WiseTech we weren't. So, I I rang up IR a few times and just said, what's going on? Let's get the non-executive directors sorted out. A lot of heavy lifting was done by Australian Super, and even Hester today are having a go at the situation. So the most, we're not, for us, WiseTech isn't, we had...
If we're a big shareholder, then we could influence the outcome.
Exactly, yeah. But there is a huge amount of pressure on him at the moment. Remarkably, he's come out with more power than he had before. So he's got good survival skills. But yeah, again, for us, being a tiny share, we had a tiny bit. We can't influence to any great extent, but I did ring up IR a few times and give them our view. But the big funds, Australian Super had $580 million that they can really influence.
Thank you.
Good morning, Geoff and panel. As always, thank you for your time today and throughout the years. My question is the same question to all of you, actually. In a sense, what we all do and we all struggle with is an amount of money that we have to invest, and the key concepts about that are the amount of money we invest in each asset, whatever that is, and the time horizon we give that asset. So to each of the fund managers, can you talk about how you manage those two concepts in your respective funds? Because I think the answer might be different for the different fund managers. And Geoff, if you could give an answer to that in the context of the new income maximiser fund.
Okay. I'll get Matt. Matt
Okay.
can answer.
I'm going to start from the smallest to the top.
Yeah, exactly.
Or maybe you go, Nick.
You start.
Yours is an easy one.
Yeah,
You've got the longest.
Yeah, exactly. I've got the longest time horizon. So we're investing typically in sort of closed-end liquid structures. So we're typically investing with underlying investment partners that are going to hold assets for somewhere between, at the short end, 3 years, at the longer end, 7 to 8 years. So it tends to be a very long investment horizon. And so I think there's a question before around sort of climate change, like thematics. And so we can sort of play more thematically in how we invest because we're thinking much more long term. That said, as a portfolio obviously is maturing, we see sort of exits come back and then we're reinvesting that capital. But it is very much with a long investment time horizon because we can't exit these assets quickly. And so when we're partnering with investment partners, we need to have obviously a high level of conviction in their skills and their ability to add value.
I've got 4 funds we've got to talk about here, but starting off with WAM Active. So and across all the 4 funds, we're looking at undervalued growth companies with a catalyst, so there's no difference between the 4. But for WAM Active, it's more shorter term, market-driven ideas, which that could be a week, it could be 1 to 2 years. That's generally the time horizon. So that's WAM Active. You got WAM Research, which is longer term.
And WAM Active would turn over
4 or 5 times a year.
4 or 5 times a year.
WAM Research is more longer dated. I would say, between 3 to 5 years. We've got the investment process we adhere to strictly. And then the complexity is WAM Capital is a mix between the two. It's 50% on the active side, 50% on the research side. So, but broadly speaking, the average holding in WAM Capital might be, say, 3 or 4 years. And then microcap, the average holding would probably be a bit longer than that. And again, is a mixture between active and research, just in smaller companies, less than 300 mil market cap.
And on the global perspective, I mean, we love to own our businesses for we'd say 1 to 3 years. We've owned some of our businesses for the entire life for the last 7 years. So it's really a matter of, do we still see catalysts in terms of the process? So we want to keep holding the business. So we'll happily hold it if this valuation's still there, if we continue to see catalysts. So as I said, we say 1 to 3 years. The turnover on average is about 30%, which would say it's about a 3-year holding period. But yeah, happy to and love to own businesses for the longer period. It's just a matter of whether the valuation and the catalysts are still there.
Yeah, and I guess for WAM leaders, we've got a very dynamic portfolio weighting process, I'd say. So every day we're getting new information, we assess it, and then we work out, do we need to change the portfolio? So it's a daily decision. The companies we own, on average, I think it was 60 to 70% we've owned for over 3 years. So it's more every day, we're very data dependent. if we're getting new data that warrants a change, we will change it so we can be highly active. So our turnover's in line with WAM Active around that 400 to 500%. And it's more the dynamic portfolio weighting. So for example, now we've got a lot of noise. We shift the weightings from, to more defensive companies. When we get a resolution of that, we'll move back, swing the portfolio back the other way. So we're really trying to capture the short-term market movements more so.
And I'll answer WAM income maximising, but I'm not managing the money. But I know the answer. And if you look at the equity part of the portfolio, which could be 100% at some point and could be zero, but we think on average it will be about 60%. That'll probably turn over 100% each year. So it'll be 1 times turnover. And in terms of what will that look like, it won't have anywhere, there's all different dynamics. It's undervalued growth, dividend income paying companies, tends to be in the top 300. So probably 15 to 20% of it will be similar stocks that are in WAM capital, and probably 50% of the stocks will be similar to WAM leaders, and there'll be some others on the equity part of the portfolios, and the weightings won't be the same. And then on the debt part, the other 40%, which can go again up and down, that'll probably be every sort of 3 years, and that's it's investment grade debt, probably 30%. Look, I've just looked at the time, and we're spot on. Actually, we're a minute or two over when we're going to have the Future Gen half hour. Please, everyone, stay in the room. Maybe we'll change the panel, and then everyone's available, for questions. For any questions that we haven't answered, we'll all be. Anyone with a little name tag on, please. When we go out there for lunch at 12:30, ask us those questions. So look, thank you very much, panel, and thank you guys. A big clap, yep.